Hey everyone, and welcome back. If you know us from Stock Talk, well, you're definitely in the right place. We're taking that same curiosity today for a real deep dive.
That's right. Today, we're focusing specifically on PepsiCo. We're looking at their first quarter 2025 results.
Yep, we've got the official Q1 2025 financial analysis right here.
And our plan really is to cut through some of the jargon,
Yeah.
get to the core story of what's happening with this huge company, especially with everything going on globally right now.
Exactly. Give you a clear picture. So let's jump in. The main figures,
Yeah.
they seem a little contradictory at first glance.
They can, yeah. You see reported revenue down 1.8%, which comes out to about $17.9 billion.
Right.
But then they also talk about organic revenue growth of 1.2%.
Okay, so what's the difference there? Why should we care about the organic number?
Well, it's a really important distinction. Reported revenue includes everything like the impact of foreign currency exchange rates, which, by the way, knocked about 3% off their revenue this quarter. It was significant.
Organic growth, it strips away those kinds of external things. Currency swings, acquisitions, divestitures. It shows you the underlying performance of the core business. Is it actually growing based on selling more stuff or getting better prices?
Gotcha. So even though the total number went down partly because of currency, the core business itself actually grew a little bit.
Precisely. It suggests some underlying strength, despite the headline figure looking a bit soft.
Okay. And what about their outlook for the rest of 2025? They adjusted that too, didn't they?
They did. They're sticking to their forecast for low single-digit organic revenue growth for the full year. So that's consistent.
Okay.
And this is the key change, they revised their earnings outlook. Their core constant currency earnings per share, or EPS, they now expect it to be roughly even with last year.
Down from what they thought before.
Yeah, previously they were guiding for mid-single-digit growth, so that's a noticeable dial back.
And why the change? What are the pressures they're seeing?
They pointed to a few main things. One is increased supply chain costs. Think materials, logistics.
Yeah.
They specifically link some of that to, global trade developments, tariffs.
Right, those ongoing issues.
Exactly. Plus, just generally elevated macroeconomic volatility around the world and what they called a subdued consumer backdrop.
So basically, it's costing them more to make and ship things. The global economy is uncertain, and maybe people are being a bit more careful with their money.
That sums it up pretty well, yeah.
Okay. If we dig a bit deeper into the financials then, how did this play out in their actual profit numbers for the quarter?
Well, it's interesting. Their gross profit was basically flat at $10 billion. But their gross profit margin actually improved. It went up to 55.8%.
How does that work? Profit flat, but margin up.
Good question. It points to a couple of things. One, positive price mix, meaning they maybe sold more higher margin products or successfully raised prices. And two, they mentioned productivity savings helping out.
So they're making a bit more on each item sold, essentially.
Right. But then when you look further down the income statement, operating profit decreased by 5% to $2.6 billion. And the operating margin also tightened, down to 14.4%.
So those higher costs, you mentioned supply chain, maybe general expenses they ate into the gains made at the gross profit level?
That's exactly what it looks like. Higher supply chain costs and also increased selling, general, and administrative expenses were the main drivers there.
And the bottom line, earnings per share.
That took a hit too. Reported EPS was down 10% to $1.33. And even their core EPS, which adjusts for certain items, was down 8.1% to $1.48.
And that includes the currency impact.
It does. If you look at core constant currency EPS trying to isolate the operational performance from currency swings, it was still down 4%.
Wow, okay, so those currency headwinds are definitely real, but even without them, the core profitability was down.
Yeah, it really underlines those dynamic and complex geopolitical and macroeconomic conditions they mentioned in the report. It's a tough environment.
Okay, let's break it down by segment. PepsiCo is huge, lots of different brands, operates everywhere. Was the performance even across the board?
Not at all. It was definitely a mixed bag. Let's start with North America, their home turf.
Right.
PepsiCo Foods North America, think Frito-Lay, Quaker. Their reported revenue dipped 1%, and organic revenue was actually down 2%.
So selling less.
Yep. Volume was down 3%, though they did get about 1% from price increases. Interestingly, their reported operating profit was up slightly, but the core constant currency operating profit fell by 7%.
A 7% drop in core profit for the North American food business. That seems significant.
Competition.
Cost pressures.
Could be all of the above. Maybe higher input costs they couldn't pass on fully. Maybe more promotional activity. Maybe consumers trading down. It's hard to say definitively from just this, but it's clearly a pressure point.
Okay, what about drinks in North America? Pepsi, Gatorade?
PepsiCo Beverages North America, or PBNA. Their reported revenue was flat, but organic revenue was up 1%.
How did they manage that?
Purely pricing. They got a 2% price increase, which offset a 1% volume decline.
So people bought slightly less, but paid more.
Exactly. But here's the really interesting part. Their reported operating profit was down 10%, but their core constant currency operating profit was up a strong 14%.
Whoa, that's a big positive swing on the core profit side. How?
Seems like really effective pricing, maybe a better mix of products sold, and strong productivity gains really paid off for them in beverages, overcoming those cost headwinds much better than the food side in North America.
Fascinating. So real divergence within North America. What about internationally?
Generally, the international picture showed more robust organic growth. For instance, the International Beverages Franchise Unit.
What does that cover exactly?
That's primarily their franchise operations for beverages outside North America. They saw organic revenue jump 7%, driven by both volume growth of 5% and price increases of 2%.
Solid growth there. Profit too.
Yep, both reported and core constant currency operating profit grew nicely there, up 6% and 12% respectively.
Okay. What about other big regions like Europe?
EMEA, Europe, Middle East, and Africa, also strong organic growth, up 8%. But look how they got there. Pricing was up a massive 16%.
16%.
Yeah, that huge price hike more than offset an 8% decline in volume.
Wow. That speaks volumes about their pricing power in that region, but an 8% volume drop, that's steep.
It really is.
Yeah.
It shows they can push price, but it definitely comes at the cost of volume. The question is, how sustainable is that? Their core constant currency operating profit was still up 13% though, so financially, the strategy worked this quarter.
Something to watch for sure. Any other international highlights or lowlights?
Latin America Foods had a tough quarter on the reported numbers, down 12% revenue, mainly due to major currency devaluation.
Oh.
Yeah, a 15% currency hit there. Organic revenue did grow 3%, but profitability was down even on a constant currency basis.
Right.
So challenging conditions in LATAM Foods.
Right.
And Asia-Pacific Foods was unusual. Reported and organic revenue were both down slightly, around 1-2%, but their volume was actually up 3.5%.
Wait, volume up, but revenue down? How?
They actually lowered prices by 4% on average in that region. Very different strategy compared to somewhere like EMEA.
Interesting. So a real patchwork quilt globally. Pricing power seems key in many places, but volume is under pressure almost everywhere, except maybe that international beverage franchise unit.
That's a great summary. Pricing is doing a lot of heavy lifting to drive that organic growth, especially offsetting volume declines and currency headwinds. International is generally stronger organically, particularly beverages.
Let's talk a bit more about those volumes overall. Convenient foods versus beverages globally.
Globally, convenient foods volume was down 3% overall for the quarter.
And that was spread evenly.
Not really. North America was only down 1%, but EMEA, as we saw, was down a hefty 9%. Latin America was down just slightly, 0.5%, while Asia Pacific was actually up 3.5%, as mentioned.
Okay, and beverages.
Overall, beverage volume was flat globally, 0% change.
Flat. But we saw declines in North America and EMEA.
Right. North America beverage volume was down 3%, EMEA down 4%. Those declines were basically offset by the growth in the International Beverages Franchise Unit, which was up 3%.
Got it. So, looking at these trends, what does it tell us about consumers right now? Are they cutting back more on snacks than drinks?
It's suggestive, isn't it? The steeper volume declines in convenient foods in some major markets, like EMEA, might hint that snacks are seen as more discretionary, maybe easier to cut back on when budgets are tight compared to beverages.
Yeah, perhaps.
But even beverages saw volume pressure in North America and EMEA. It definitely points to a more price-conscious consumer overall, maybe making trade-offs, buying less often, perhaps choosing private label sometimes. The dynamics clearly vary a lot by region and category.
Makes sense. Okay, shifting gears slightly, let's look under the hood at their financial health. Balance sheet, cash flow. How's that looking?
Well, operating cash flow was actually negative $1.0 billion for the quarter.
Negative. Is that bad?
Not necessarily. They explained it's quite typical for their first quarter due to seasonality and working capital needs. It was actually a slight improvement compared to Q1 last year.
Okay, so seasonal. What about spending and shareholder returns?
Capital expenditures were around $7.6 billion, slightly down year over year, and they returned a good chunk to shareholders, just over $2 billion in total.
How is that split?
About $1.88 billion in dividends and $183 million in share repurchases. Both those figures are up compared to Q1 2024.
And their overall financial position, cash, debt.
They look solid. They ended the quarter with $8.6 billion in cash and short-term investments. Total debt was $48.5 billion, which is up a bit from the end of last year, partly due to some new debt they issued.
And they're sticking to their plan for shareholder returns for the full year.
Yes, they reaffirmed the target of returning about $8.6 billion for the full year 2025. And they made a point of mentioning their recent dividend increase.
It's a 5% increase.
That's the one. It marked their 53rd consecutive annual dividend increase. Well, that's a long streak. It signals confidence and a long-term commitment, even amidst current pressures.
53 years. That's impressive. Okay, so let's circle back to that updated outlook. We know organic revenue growth is still expected to be low single digits, but core constant currency EPS is now flat. What are the big flashing warning signs they're highlighting?
It really hammers home those key headwinds we've been discussing. Number one, those higher supply chain costs, explicitly mentioning tariffs and global trade impacts. Number two, the ongoing macroeconomic volatility and the resulting subdued consumer spending.
Right.
And number three, those foreign exchange headwinds are expected to persist. They estimate about a 3 percentage point negative impact on reported EPS for the full year from currency alone.
So revenue growth is holding up okay organically, but costs and currency are really squeezing the profit outlook.
That's the story in a nutshell.
Did the CEO, Ramon Laguarta, give any sense of how they plan to fight back against these pressures?
He did comment on that. He talked about actively working on mitigation actions for the supply chain costs, trying to manage that without disrupting things too much. He also emphasized building on the momentum they have internationally.
Makes sense, given the results we saw.
Yeah, while also focusing on improving performance back here in North America, especially, you'd assume, on the food side, profits and beverage volumes. And he highlighted ongoing productivity initiatives across the company as being crucial.
Using efficiency to offset some of the cost pain.
Exactly. Funding investments and protecting margins as best they can. The overall tone was, acknowledging the tough operating environment, but staying focused on long-term health.
Okay. So based on their report, what are the key risks and, conversely, the key opportunities they see going forward?
On the risk side, it's largely what we've discussed. Those supply chain cost pressures, particularly tariffs, the risk that volumes stay weak if consumers remain price sensitive, the FX headwinds, general consumer sentiment staying low, and of course, geopolitical instability.
A familiar list in today's world. What about the flip side? Where do they see potential upside or opportunities?
They mentioned a few key areas. Their own internal productivity programs are seen as a big lever, continued expansion and growth internationally. Specifically, improving performance in North America is framed as an opportunity, the potential for consumer spending to eventually recover, and they believe their disciplined investments will pay off.
So internal efficiencies, international growth, fixing North America, and hoping the consumer comes back strong.
That's a fair summary of the opportunities they highlighted, yes.
All right, so if we were to boil down this whole deep dive on PepsiCo's Q1, what's the big picture message?
I think the main takeaway is resilience, really. They managed to grow their underlying business organically, which is quite an achievement in this complex environment.
Yeah.
Key strengths were that organic growth, their ability to raise prices significantly in many markets, the strong performance of international beverages, that gross margin improvement, and the continued commitment to dividends.
But definitely not without challenges.
Absolutely not. The key focus areas, or maybe pressure points, are clearly those rising supply chain costs, getting North America firing on all cylinders again, managing the significant currency impacts, finding the right balance between price and volume, and executing on those productivity plans.
So navigating a tricky path, basically. Using pricing power but facing volume and cost headwinds, trying to keep focused on the long game.
That sums it up well.
Okay, so just to quickly recap for everyone listening, PepsiCo's first quarter showed that slight dip in reported revenue, mainly due to currency, but positive underlying organic growth. Still, profitability is being squeezed by higher costs and some consumer caution, leading to that revised, flatter earnings outlook for the year.
And we saw really varied performance across regions and product lines, international, doing better organically, especially beverages, while North America had a more mixed result. Pricing was a huge factor everywhere.
Right. And hopefully understanding these dynamics gives you, the listener, some valuable insight into what a major global company like this is dealing with and maybe what it reflects about the wider economy, too.
Definitely. It's a useful lens.
So here's a final thought to leave you with. Considering PepsiCo strategies, pushing international growth, trying to fix North America, relying on pricing and facing all these global challenges, what do you think is the single biggest hurdle they'll face in actually achieving their long-term growth ambitions? Is it costs? Is it changing consumers? Competition?
That's a great question to ponder. How might shifting consumer tastes in different parts of the world impact them down the line? There's a lot to think about there. We really encourage you to take what we've discussed as a starting point for your own thinking.
Absolutely. Thanks so much for joining us for this deep dive into PepsiCo.
Yeah, thanks for tuning in.
We'll catch you on the next one.